Retiree Li Leong has a new hobby: investing. The 68-year-old now spends his free time monitoring his stock portfolio.
The main ones are marine, oil and gas industry. Then followed, you'll be surprised, is transportation, and then technic, the tech industry.
The retired pilot only began investing at the age of 65, having focused on family and career before that.
All this time I wanted to go into it, but I don't have the time to do it. So retirement gave me that opportunity. After retirement, I got plenty of time. Then also accumulated some funds, some capital. And so I guess it's a good time to start going serious about my investment.
The market has been kind to Mr. Lee over the past 3 years, and he's been able to supplement his income to travel. But he does wish he had a longer runway.
I wish I could have started earlier. But then that's all right, I think when the opportunity knocks, come knocking on your door, you got to grab it at any age, right? Yeah, whether you're 20 or you're 80.
Experts agree it's ideal to have started earlier on.
When you have time, you can allow your money to compound and grow, and you can also be a bit more aggressive because you've got time to ride through market cycles, you've got time to ride through volatility in the market. So with that time, you can be more aggressive, and that's a big advantage.
Take, for example, a 25-year-old who starts investing $750 a month till the age of 35. Over 10 years, that's $90,000 in their investment pool. If they don't touch it and let it compound, they would have $2.15 million at the age of 65. This assumes the S&P 500's average return over the last 10 years of about 9% after adjusting for inflation. On the other hand, take somebody who started at the age of 35 and invest the same amount each month for 30 years. That's 3 times the total amount. At age 65, they'd have $1.45 million.
It's a $700,000 difference, and the first person put in 1/3 the amount. So it's massive, massive difference, and this is the beauty of compounding return, which the only way you can make use of is time. I think Einstein is attributed with the quote, compounding return is the 8th wonder of the world.
Still, it doesn't mean you can't catch up if you didn't start young.
Well, I'd say, look, yes, time has passed, but if you think about it, someone who didn't start investing this $1,000 a month into equities early, you probably would have invested in a home, possibly, and then the equity in the home would have grown, and there would be a compounding return in there over the past 20 years, for example. So one day that person might right-size, shift to a smaller home, and free up that liquidity. And in some form, they have participated in compounding return over the years. So yeah, don't be disheartened.
If you have missed the boat on being an investor, it's probably because you don't feel comfortable about being an investor. You don't feel comfortable about the risk of the market going down. So it's all about having the right sort of investment plan and moving into the market with your investments from where you're taking them, which is very safe, into a market at a slow pace, at a slow measured pace into the market.
To get started at an older age, come up with a statement of net worth first. That involves listing all your assets and liabilities. Look at your income and expenses and project them in retirement. Once you know how much you're going to be spending, you'll know how much you need to derive from your investment portfolio to meet those numbers. Typically, older investors should consider strategies that minimize risk while preserving capital.
So very commonly, you'd see maybe an 80%, 70% bond or fixed income portfolio with 20 or 30% allocation to equities for some capital upside. And very often for that 20 or 30%, you'd see those equities are dividend paying as well to try and boost the income that they get from the portfolio.
An even lower risk option is to make better use of your CPF.
I would as I do personally, I would definitely look to use the supplementary retirement scheme as much as you can to invest what you're allowed to invest to the limit each year and have that inside your portfolio.
One thing to be aware of is that your CPF Life actually has a pretty good yield, a pretty good rate of return with no risk. So sometimes instead of thinking of an investment portfolio where you may be concerned about volatility, one simple option is topping up to the enhanced retirement sum to boost your monthly payouts. That could be a good way to get income in a risk-free way.
For older investors in particular, it's also important to review your allocation periodically. The older you get, the more you'll want to shift to fixed income assets. At the same time, make sure you're not caught out paying excessive fees.
The most important thing is keeping the costs down and not paying very expensive fees to advisors who then turn around and put you into funds that have fees. So layering one lot of fees on top of another lot of fees will always erode your returns. If you're paying 1% a year to an advisor and they're putting you in a fund which charges 1.5% a year, you're losing 2.5% before day one, and that's not a great thing to do over the long term. That will really harm your performance.
With life expectancy in Singapore now at 83, even starting at age 60 gives you 2 decades to build your wealth. So it's important to just get started.
Put your money down, invest, get started. But again, I'm not saying that you go in blindly, You got to also, first of all, ask yourself the question whether you are suitable to invest, your risk attitude, how much risk you're willing to take, how much money you're going to willing to pour into your investment, and the time that you need to follow it. And once all that answered, and you still feel that you're the suitable person to go in with your both eyes wide open. Just plunge in and take the first step. And then the rest will come naturally.